Hello, everybody. Welcome to Gossip Finance. It's your host, Duncan. Lacey's is not with me today. She's been out of town. So today I'm just going to go over some stuff, just talking about stocks, what they are, how it works, kind of how to look at the market, and the different analysis ideas behind looking at stocks. So stocks essentially, just simplified in a nutshell, are a company's ways to finance. It's one way a company can finance projects, growth, whatever they want to do. So I'm a company. I need money because I want to build a new factory because I'm expanding as a company, and I don't have the money. So I have to get the money from somewhere. One way I can do it is by selling stock in my company. Now I can sell stock, people buy it, and they get shares of those stocks, right? Which means they have an ownership in the company. A lot of times, stocks come with a voting privilege in the sale. So if you buy 100 shares and you buy one share, you have 1% of the vote for major decisions that come on in the company. The value of buying a stock is that you buy it at a certain price. It gives you that ownership in the company. It gives you hypothetically access to the profits of the company. Hypothetically, it doesn't actually give you that unless the company deems to give out parts of the profit, which we'll get into. They're called dividends. But what it does give you is the value of the stock. And there are two markets that this goes into. The primary market. So if I'm a new company and I just sell you a stock and you buy it from me, that's the primary market. The next market is the secondary market. It's, can you sell that stock to somebody else? Because if you can't, then the only person you could sell it to is me, right? And if I don't want to buy it, you're kind of out of luck. So if you buy the stock from me for $10 and you think it's worth 12 or 13 now, or maybe that's what I'm selling them for now because the value of the company's gone up, and you want to sell it back, you have to find somebody who's either willing to buy it from you, which would be a secondary market, which is difficult to do, or you're going to have to sell it back to me if there's no secondary market. And if I'm not buying, then you're stuck with it. That's where things like the New York Stock Exchange come into value. NASDAQ, the Nikkei index in Japan, et cetera, et cetera, et cetera. These are secondary markets. What they do is they create a market to trade these stocks with everybody else worldwide. And that's what you really want. And because those are liquid, they're easier to trade, they're easier to move. So you buy the stock. I issue the stock from my company, Gossip Finance Corporation. We issue stock. You buy some stock, and the value of the stock, let's say you buy it at $10 a share. Well, what increases the value? Well, what's going to increase the value is demand for the stock, essentially, is the main factor. Okay, do people want to buy the stock? Well, if they want to buy the stock, then the price is going to go up, right? Because there's more demand, and there's only a finite number of shares. And then the value goes up, and then you can eventually sell it and make more money. If the value goes down, demand goes down, nobody wants it, well, then you still own the stock. You haven't lost any money yet. But if you sell it at the lower price, you've lost money. So that's essentially the concept behind what a stock is in a nutshell. And I'm going to give you a quick thing here. Hang on one sec. Oh, gosh, everything's so slow today. So let's do this. So a stock is basically, once again, for a company to raise money. I need money for a project, or I want to grow as a company or expand. I need cash. So I'm going to sell you the stock. I'm going to sell you ownership of my company, and you're going to give me cash for that. So now I have cash to expand the company, right? So it's basically a way a company can almost print their own currency in sort of a nominal sense. That gives you, the person who owns the stock, ownership of the company. Now, not all stock shares do this, but the vast majority do. And the value of the stock grows based on the demand. Now, the different types of ways you can analyze whether or not you want to buy a stock. The main two are going to be technical analysis and fundamental analysis. So technical analysis really goes out, you're looking at trends in the price movement of that stock, comparing it to other things, comparing it to trend movements in the markets. And there are lots of different ways to do this, and technical analysis or techies, they have different concepts. Like I could put some examples here: head and shoulders, cup and handle, double top, golden cross versus death cross. Now let me show you golden cross versus death cross, because I think this is probably the most efficient. So I just took this simple example here. This is actually, let's do this one instead. So this is Disney Corp, right? So Disney Corp, starts out small and it grows, and then they had some bad years, and then they kind of plateau here for a long time, and then some things happen and they grew again. So this is a normal cycle for a business, that there's rapid growth years, and then there's years where they're just kind of flat for a long period of time, and sometimes, like in Disney's case, you see another rapid growth year because something happens or they change, and then they kind of go flat and they kind of plateau again. And then this sort of cycle keeps going until either the company just stays sort of plateaued because they've maxed out where they're at for a long period of time, or eventually they go down because they've lost value. In Disney's case, they've seen a pretty good growth, but they have long periods where they just plateau. So I'm going to use a quick example here. So let's do this. I've got these lines in here, these red and black lines. See the red line there and the black line there. So let me do this. Let me get it to a point where it's green. There we go. So you can see the red line. The red line is a 10-day moving average, okay? So this is just the average change in price over 10 days. So this is going to be a little bit more dramatic. The black line is a 50-day moving average, so the average moving price of 50 days. So it's going to tend to be a little bit more stable. Now, when they talk about these things, if you have the red line here, it goes down below the black line, right? The red line, the shorter moving average, the 10-day moving average goes below the 50-day moving average, like that. This is what's called a death cross. When the shorter one crosses below the longer term moving average. This is an indicator of, sustained loss generally, usually long-term loss. In this case, it wasn't very long-term. It was a few months, 6 months, 8 months, whatever it was. But that's what it's an indicator of. So a technical analysis would see that cross happen and go, okay, well, now's the time to either get out of Disney or bet against Disney or short Disney, right? Because that's where the money's going to be. On the other side of the coin, you see later on here, the red line moves above the black line, right? The shorter moving average, the red line, moves above the longer moving average, the black line, over here. That's called a golden cross. That shows that it's an indicator that there's going to be substantial growth, hopefully long-term growth, but that's what it's an indicator of in a technical analysis perspective. This isn't always true, but it does, there is some consistency to it. And so a technical analysis would look at these sorts of things and go, okay, well, now the red line's moved above the black line at this point. So now I'm going to make the assumption that, look, it's going to go up over time. And it did for a few months. And then it went down again. So that would be a basic concept of a technical analysis. There's lots and lots of different theories and things that go on, like they tend to want to invest more in like retail stocks at the end of the year, or Super Bowl Sunday or Black Friday, things like that. So I mean, there's lots of different things that go into technical analysis. You can Google it and go through lots of different analysis and how they do it, but that's what a technical analysis would be. Just be wary, because it's not necessarily correct all the time. It's just hypothesis. So that would be a technical analysis. The second one would be a fundamental analysis. Okay, so in a fundamental analysis, what I'm looking at is the business itself. Okay, do I think this is a business has a lot of growth potential, or do I think it's a value business? So growth and value are the two different things you might be looking at. And I'm sure you guys have seen that before, where they have like mutual funds or ETFs or things. They're growth stock funds, or their growth value, or their value funds, et cetera, et cetera. But those are the two general concepts you're looking at. Growth means that you're looking at a company that you think has the potential to grow and sustain a big growth and a lot of profits, right? So going back to Disney here for a second, if we go back over a longer period of time, so we go back to, this goes back to what, 2002 to today, Disney was flat here for a long time, but it eventually, in here in 2011, hit a stride and became more of a growth stock over time because it had a lot of growth potential. And as you see, it grew rapidly over that time period, right? And now it's kind of died out and from the markets, and been a lot of crazy stuff in the markets lately that have been down, mainly because of inflation. But that's one of the things. But it was a growth stock for a while here, where it had this rapid expansion. Okay, so that would be a growth stock. And so when you're looking for a growth stock, that's essentially what you're looking for. You're looking for something you think is going to rapidly expand over time. A value stock, on the other hand, is something you're looking for is, do you think the stock is undervalued right now, or is it overvalued at the time that you're looking at the stock? The way you generally kind of do this in a simple way is you look at the capitalization of the company. So that's all their assets, their cash value, all that stuff. And you go, what is the capitalization? It's an accounting method, essentially. So you're looking at the capitalization. This is what the company, I think, overall right now is sort of worth in cash, right? Well, not just in cash, but in assets. That's what I think it's worth. Then what I'm going to do is I'm going to divide that by the number of shares outstanding, right? So I gave a little example here. I have 100 shares outstanding. I think the capitalization of the company is worth $1,000, right? So I'm going to divide 1,000 by the 100 shares. So I think the value of the company is $10 a share. I think that's the real value. Okay. But once again, the stocks don't just trade on the actual value, they trade on demand for the stock, right? Just like any other product. So if right now, I think it's worth $10 a share, but it's trading on the market at, say, $8 a share, that would be an undervalued stock through my assessment. Okay. And I would assess, okay, well, I think that stock is undervalued. I think it should be worth 10, but it's selling for 8. So if I buy it at 8 and it's worth 10, I'm getting a deal because I think it's eventually going to go up to 10 or maybe higher, right? However, if the stock is trading for like 12, then it's overvalued because I only think it's worth 10. So why would I pay 12 for it if I think it's going to come back to 10? So that's kind of how you do the valuation for value and undervalued versus overvalued. I'm really simplifying this. I just want to give the concepts. So that's kind of the idea. Is growth is you think it's got a long-term growth potential. Value is I think it's worth more than it's selling for now, or I think it's worth less than it's selling for now. So that's kind of the two general analysis on a fundamental analysis. Okay. And on a fundamental analysis, there are a couple things you do. You can go top down or you can go bottom up. So top down would be, I'm looking at a specific sector or industry or something like that. And then I'm going to work down and look for what stocks do I think have good growth potential or are undervalued stocks or overvalued stocks within that. So if I start with Disney, for example, I'm going to start with, okay, who's doing entertainment industry, right? And so I'm going to whittle it down and go, okay, well, there's Disney and there's MGM and there's these studios and those studios. And I think this one might be undervalued or this one might be overvalued. Right now, I might think Disney's probably a little, you know, overvalued or undervalued. Its stock has gone down quite a bit, though it was higher. I would look at the capitalization and go, well, do I think Disney's going to be a growth stock? I don't know. Probably not. They're probably kind of hit their stride unless something new comes out that we're not aware of. So that's essentially what you do. And the way you do it is you start out, a lot of people start out, you'll look at these things. They're called, this is a Form 10K. They also do 10Qs and whatnot. They're just Security Exchange Commission forms, SEC forms that companies that have stock have to file, and they have to make them public. So this is 10K is the annual report. Okay. So in the annual report, they're going to go through a bunch of stuff. But the main things you're going to be wanting to look at is kind of what's the business, what's their goals, do you think there's some growth factor there? Then you're going to look at the risk factors that they list. Now, understand this is the risk factors, the growth factors, and the risk factors the company reports. They're required to report to their shareholders. There might be other things you're missing, which is why you have to look at the news and other reports and do a lot of research. But you'll go down through that, and then of course they'll give you the common equity and all that stuff, and their statements will all be in this report. And so you have to read through these. You have to pay attention to the news and figure: do I think it's undervalued? Do I think it's overvalued? Do I think it has big growth potential or not? So it's just a lot of general research going into this sort of thing. So where was I? Oh, so the other thing is dividends, or what are called income stocks. Um, Dividends are paid by the company from the profit. So the company, in this case, you bought a stock from me at $10, but my company, the stock price isn't going up. It's pretty much leveled out, but the company makes good money. So I don't want you to sell your stocks. I don't want the price of the stock to go down. So what I do is I issue a dividend, and I say, okay, maybe every quarter, maybe twice a year, maybe once a year, I'm going to take a portion of the profits, and then I'm going to pay a dividend to all the shareholders, right? So if there's 100 shares outstanding, like before, and we made $2,000 that I'm going to put out into dividends, then every shareholder, 2,000 divided by 100, every shareholder will get $20 per share. Okay. So Disney, again, is a great example of this. So all these D's are dividends that Disney pays. And the reason is because Disney doesn't have a huge growth potential, and they know it. They've pretty much leveled out where they're at. So they pay regular dividends to shareholders to keep the shareholders invested. So the shareholders, even though the stock might not be growing that much, they're still getting something, at least regularly. So these are called income stocks. So they pay you on a fairly regular basis, and it's pretty predictable. So that would be the basic kinds of stocks, right? Um, you'd be looking at either technical analysis, fundamental analysis. In fundamental analysis, you're looking at, is it a growth stock? Is it a value stock? Or is it an income stock? So those are the kind of general stocks you're looking at. So when you go through these things, I would like to tell you there's some simple answer to this. And a lot of people say, oh, buy this or buy that or do this, or whatever. It's really not that simple. You have to sit down and make an assessment. And if somebody makes an assessment, they could be right, they could be wrong. There's no real way to know. For long-term investing in individual stocks is not a great idea because they carry more risk. I'll give you a great example. So Kanye West has recently been in trouble in the news, right, for anti-Semitic stuff, and he lost a huge contract with Adidas. Now, this is going to negatively affect Adidas' shares, but it's not going to affect Nike, even though Nike and Adidas are in the same business, right? So that would be a higher risk level because you're taking on not just the sector risk or the government risk, you're taking on all the individual risks of the company itself, right? So Kanye is an added risk factor to Adidas, or was, until they fired him. and that will affect the price of the stock. So there's more risk factor in individual stocks versus diversifying and buying, portfolios of stocks. So let's take a look at this real quick. I want to do this one quick report, and then we'll wrap up here just to give you some concepts. So this is just Yahoo Finance, and this is this morning, Friday, December 2nd, or is it December 3rd? December 2nd, sorry. This is just sort of what's going on right now in the market today.
Recapping the jobs numbers that we got just a little while ago, 263,000 jobs added to the U.S. economy last month. That is much stronger than the 200,000 that was estimated. The unemployment rate bang in line with estimates of 3.7%, and hot wage growth, 5.1% year over year. Let's dig into this a little bit more. I'll talk about the implications for the Federal Reserve.
Okay. So just to clarify, this is a big news event in the stock market. The jobs report came out, right, for last month. They were expecting 200,000 jobs and ended up being over 260. So, hey, great jobs numbers, right? Things are better than we thought. Wage growth higher than expected. It's over 5. I can't remember what they expected before, but it's less than that. So we've seen growth in the economy, right? The problem is right now we have high inflation. So if you see wage growth and more jobs, that means more people working, which means more money is being pumped into the system, which means inflation is going to be high or stay high or get higher. Because the more money there is versus demand, you see more inflation for goods, right? The cost goes up. And right now, that's an economic problem that the Federal Reserve is trying to deal with, is to keep inflation down. You don't want inflation too high because then things get out of control and people can't afford to live. So even though this report is generally good based on the circumstance we're in now, it's actually seen as kind of a negative. And let me show you this. Here is the S&P 500. This was yesterday at close, at the peak here, right? And this was this morning at open. It's a huge drop. It went from 4,076 to 4,039. So a big drop in the market because of this news. People panicked because it means that inflation is still high. It means the Federal Reserve, because inflation is still high, and there's nothing, and this jobs report does not show that that's going to slow. Even though the jobs report's good, it's good, but it's bad for inflation, which means the Federal Reserve is going to start saying, well, we're going to keep raising interest rates to try and tamp down inflation, right? Which is going to squeeze the market. I know this got really nerdy, but essentially what's happening is the Fed's going to say, we're going to raise inflation so it's harder to get a loan, to get a house or a car or start a business or do anything. We're going to raise those rates. Why? Because we want to stifle the amount of money that's going out into the economy right now. Because if there's less money, there's less spending, and inflation will go down. That's monetary policy, and that's the theory. And that's what they're doing, and that's what they're going to continue to do. The fact that the jobs report was good is an indication that's going to continue, which means money is going to be more expensive. So that means that stocks are not going to be worth as much because the loans and the values of the companies are going to have to go down because money is going to become more expensive. So that was a panic sell-off, and that's what happened here. And as you can see, we have our 10-day moving average in the red line and our 50-day moving average. And what happened? It went below it. So you have a technical analysis. You have a death cross. So there's a fundamental analysis right there on what happened, right? The jobs report was good, which means inflation is going to be still bad, which means things are going to get more expensive, which means interest rates are going to go up, which means it's going to be harder to buy. So it's bad for the market in general. And then there's the technical analysis where you see, hey, look, oh, yep, it crossed. Now we know it's probably going to stay down and low for a period of time. So that's just giving you an idea. And this is the stock market in general, and it's just a good example. But that's how you kind of break down these things. But once you see there's a lot of moving parts, right? And the old saying is it baked into the cake, right? Which means you can pick a stock and think it's great. I could pick Adidas and their portfolio looks great and everything looks good and I think they're undervalued and I think they're going to have a good run, and then boom, Kanye goes out and says a bunch of anti-Semitic things and it tanks their stock, and I take a bath on that until it comes back, if it comes back. So that's sort of the difficulty in stock analysis, is there's just so many factors that could come in. So when you're making a stock analysis, that's the kind of stuff you're facing. Um, anyway, we'll be back this week. Sorry, we were kind of slow. I got in a little bit of an accident. That's why my face is a little funny looking today. And Lace will be back, and we're going to do some fun videos for you guys. I hope you enjoyed this. I hope this was helpful. So as you can see, there's a lot that gets baked into how you pick stocks or how you invest in these sorts of things. Typically, I would recommend you diversify, get a portfolio and diversify it and invest over a long period of time. And you don't play these day to day, month to month, week to week games, because it can go either way. Um, and it gets really difficult. I know you're going to see a lot of, like I said earlier, you're going to see a lot of stuff online about, well, this is the stock or that's the stock or this is the pick or that's the pick. I'm going to tell you a fun story. Back in probably was it 2010 or 11 or something like that. You can look this up. The stock picking cat. Just Google stock picking cat. What happened was in London, they did a contest for, you pick whatever it was, 10 stocks, and whoever picked the 10 stocks that were the most successful won some prize. And the woman who won didn't really have much experience. What she did was she put out the stocks on a newspaper, and she put her cat's favorite little toy on the newspaper, and wherever the cat batted the toy and wherever the toy landed, those were the stocks she picked. And the cat ended up winning by a lot over the best investors and stock pickers and guys doing the best research available with all the money in the world, lost to a cat batting a toy on a newspaper. So it's kind of hard to sit there and go, well, you can pick the right stocks or you know what you're going to do. It's better to play a longer term game. And the way to do that is to diversify and be more strategic. And we'll talk more about that in later videos. We're going to talk more about diversification, and we're going to talk about ETFs and mutual funds and portfolios and how those things work. I hope this was helpful. I hope you enjoyed it. Best wishes on your investing, and have a great day. Thank you very much.